Hello, everyone, and welcome to this AIMIC Academy on captive claims. My name is Richard Cutcher. I'm kind of AIMIC's captive ambassador. I run the AIMIC Captive Special Interest Group. And anything that we do regards to captives, I tend to be involved in and coordinate. And really good to see so many people tuning in for this Captive Claims Academy. And I think it's quite reflective of the fact that captives are kind of back in fashion at the moment with obviously the hardening market. I know we've got members tuning in who already have captives and maybe they want to learn a bit more or brush up on how the kind of different claim systems can work, and we're going to touch on some of those. And I also see that we've got members on the call, on the session, sorry, that don't have a captive yet, or maybe are exploring one. So hopefully this is going to be useful for all different kind of delegates. And we've got three really good speakers here who kind of cross the whole gambit of this topic, I imagine. We've got Owen Williams, Global Programs and Captives Regional Director for UK, Nordics and Ireland at AXA XL. We have Catherine Barron, Head of Casualty Claims UK at AXA XL. And we have James Rayner, Vice President and Global Relationship Leader at Crawford and Company. And over the next 30 minutes or so, because we want to leave lots of time for questions, we're going to kind of cover the following learning objectives. We're going to talk about just how claims work generally, when there's a captive involved and when there isn't a captive involved, identify those differences, the different structures that can be used for captives and how that impacts how claims are managed, the different roles of TPAs and fronting companies, hence our panelist here, and then the claims processes and what needs to be in place to run a successful captive program and claims management as well. So I'm going to hand over first to Owen Williams. If you do have questions, please do put them in the question box on the webinar portal, and I'll pick them up. And if I can ask them along the way, I will try and do that. Otherwise, we are planning to leave lots of time at the end to take questions. So please do submit those questions and we will get to them. But in the meantime, Owen, over to you.
Thank you, Richard, and thank you to everyone on the call for dialing in as well. So, as Richard said there, we'll take you through some of the, captive structures and particularly a claims reference on it. But I just thought as a first point around this conversation, perhaps to just say, well, what is a captive, really super briefly, and just cover off some of the things around setting up captives. So, I mean, I'm sure everyone on the call probably understands this, but very simply, in its simplest term, a captive is simply an insurance or reinsurance company. There are nuances within that, so you'll hear people talk about PCCs and SPCs and all this kind of stuff, but the reality is that for the UK market, the vast majority of captives, certainly in the traditional risk space, are single parent captives, so captives owned by their parent, writing the risk of their parent. But the nuance I think we'll get into today a bit more is the difference between a insurance captive and a reinsurance captive, because that has a fundamental impact on how claims are handled. So just to touch off a couple of I guess positive points initially, Richard mentioned about captives being somewhat on vogue again. I don't know, I would say they never went out of fashion, but then I guess I would say that. But certainly, when you look at what's happening in the market right now, captives are a great way of sharing in your risk, showing an insurer that you are prepared to put your money where your mouth is in terms of risk. They're also a fantastic way of consolidating the risk across your business in one entity. So, for example, if you are taking larger retentions that become too large for a local business, they're a fantastic way of globally, corporately, you taking that risk without negatively impacting your local business. And they're also, I mean, people talk about using them, and this is very true, around rewarding risk management as well. So they're a really strong way of rewarding good local practice around risk management, because you can control premium levels within your captive, within territories. So there's a lot of positives there. Having said that, nothing comes for free in this world. So particularly with captives, there is a time investment, both in setting up that captive, and the ongoing management of that captive. And I think it's interesting because right now, with the market as it is, we're seeing a lot of people looking at setting up captives, and they're understandably perhaps looking to do that in a hurry. And it's I mean, clearly it can be done on a fast track timeline, but there's challenges with that as well. And perhaps one of the things that sometimes does get missed when you're working on a contracted timeline is actually really thinking through what is it I want as a client from a claims. How do I want my claims to be handled, and will this structure that I'm putting in place achieve that for me? So yeah, it's a very good solution, particularly pertinent right now. But timing is always important. So I've just got a couple of slides here. I won't go into too much detail on them, but just to really make sure that we all kind of understand some structuring issues or structuring options, should I say, and the impacts, positive and negative, that will have on how claims are handled. So just to start the base point, super simple, no captive. Traditional insurance policy, an insured purchasing cover from an insurer, paying them premium, having claims paid back to them. Obviously, very familiar, not much to say about that. What I would say about that, though, is just have in mind premium flowing one way, claims flowing the other way. It's all flowing under the guise of an insurance wording. That wording, that contract between the two entities, is how all monies flow back and forward between the two and all liabilities. So obviously, very simple thing to put on the slide, and forgive me for doing that, but I'm just doing that because it just sets the scene for the next two slides or next three slides that we'll talk through. So if we can just flick to the next slide, please. So this is a direct writing captive structure. So, and this is, I think, when people very first think of a captive, certainly from a claims viewpoint, this is perhaps what people are imagining and envisaging. So, because people will say, well, great, okay, I'm going to bring a captive in. That means I can do what I want with my claims within that captive. Now, in this kind of structure where you have an insurance policy that exists between the captive and the insured, and then a separate insurance policy that exists between between the insured and the insurer in excess of what the captive is taking, and the claims and premium flowing on those two separate contracts. I mean, yes, in theory, in this kind of structure, the captive, they are handling the claims. So they have autonomy on how they are handling those claims. It's worth pointing out the captive is still subject to regulation as the insurer, so it can't just go paying anything it wants to in any way it wants to. But then the challenge with this kind of structure would be, okay, if the captive is going to handle the claims, do they have the resource to handle claims? Do they have the necessary knowledge and know-how? And the honest answer in most circumstances, not all, but most, is probably not, particularly a new startup captive. Now there are options there, so you can, as a captive, obviously delegate that claims handling out to a TPA such as Crawford, which I think James will talk about a bit later. So there certainly are options there, but just from a pure, when people first go on this journey and they think about captives and think about having a captive and they think, I'm going to control my claims, this is, I think, what people envisage. Now the reality from most clients is that they actually end up on the next structure, the next slide, excuse me, which is a fronted captive. So this is where you have a captive reinsurer rather than a captive insurer. So here, as per the first slide, there is an insured and there is an insurer, and there is an insurance contract between them, and everything flows based on that insurance contract. Now the captive participates as a reinsurer to the insurer, and there is a reinsurance agreement entirely separate to the insurance contract. There's a reinsurance agreement that exists between the insurer and the captive, and the insurer is passing premium back to the captive and recovering claims from the captive. But the thing that obviously is distinctly different from a claims perspective, at least, between this structure and the one before, is the captive is no longer handling those claims. The captive is handling a reinsurance claim from the insurer. And most reinsurance agreements between an insurer and a captive will be on a full follow fortunes basis. So in reality, whatever's being paid at the front end by the insurer to the insured is what the captive will be then reimbursing for. So obviously the reason that most people have this structure is, generally speaking, captives aren't licensed or don't have sufficient licensing to write direct. That they may in certain territories, but they're unlikely to have a spread of licensing, outside of perhaps their home territory. And even in their home territory, they may not be registered as an insurance vehicle. They're more likely to be registered as a reinsurance vehicle. So it's just important, I think, that when you're setting up a captive and thinking about a captive, you really think about the structure that you're going to have and what that is going to mean, therefore, for how you are handling claims. So I guess the positive here for a captive is you don't need significant claims handling resource because you're on a follow fortunes basis to what's happening to the insurer. But the negative is you're not controlling the claims in the way that you may have envisaged when you first sort of had the idea that you were going to establish a captive. We can just move to the next slide. It just shows something in a slightly different angle. So we talked about captives having licenses or not to write insurance. Now, obviously, when you engage a fronter, the fronter will most likely be required to issue contract in a number of local territories for you as a client. Rather, I mean, they could issue in one territory if that was the structure and what was needed, but more likely than not, they'd be issuing in multiple territories. So you can see here, territories 1, 2, and 3. What I'm trying to demonstrate here is an insurer. So if you take AXA XL as an example, may have entities in territories 1, 2, and 3. So at that point, you've engaged AXA XL or another fronter. They're fronting for you, and they're issuing in those territories. But you may need policies in territories where the fronter doesn't have licensing, and most fronters at that point will be engaging a network partner. So a third-party insurer, not part of their group, but who they have a contract with to issue contracts on their behalf, issue insurance policies on their behalf. For territories 4 and 5, you now have a kind of added layer of complexity here, which is, if you think about that claim being handled on the front end to you as an insured, you'll have a network partner handling that claim, who is then reinsuring that via partner agreement to your fronter, who is then reinsuring that to your captive. So, in this kind of scenario, your captive is becoming one step further down the chain than you perhaps would have envisaged even in the last slide. And I think it's just important to really think about that, because a common sort of comment that I would hear is, well, it's my captive, it's my money. And it's kind of like, well, yes, ultimately, when all is said and done, it is. But the reality is, the P&L of those territories and the P&L of that fronter and all the regulatory responsibility, they are recording those claims, handling those claims from their balance sheets. So the actual claim, the true claim between the insured and the insurer at the front end is not the captive's claim. It becomes the captive's claim once it becomes a reinsurance claim. And it's just important to sort of have that in mind when you're thinking about structures, and when you're thinking about process around this as well, because, and I'm sure James will talk about this a bit as well, but obviously you may well have a TPA engaged on this as well, and particularly in certain territories, for example, providing data. But each layer here adds another layer of potential complexity. So you things like, as claims flow through a process, you have FX changes, for example, as it comes through. Now, all these things are manageable, absolutely, but it's just very important to understand your structure right from the outset and set in place a really clear process that everyone throughout always going to be involved in this understands and is kind of signed up to and agreed with. And often, and it probably is particularly topical right now with people setting up captives on a shortened time frame, this kind of stuff isn't really thought through necessarily at the initial stage. So with that, I will pass to Catherine. I think it's going to kind of give a bit more claims view in a bit more detail, hopefully.
Thanks, Owen. Thanks, Owen, and thank you everyone for joining us this morning. I'm going to take us back to basics just for one slide, and just to remind everybody, but I'm sure you already know, that an insurance policy is a promise, and it's a contract where a payment will be met when certain things happen. So at a really personal, basic level, your car gets stolen, as long as you've got the right, it's really important, insurance in place, you meet the terms and conditions, the insurer will replace your car. So at the level we're talking about today, at the business level, it's exactly the same principle, it's just on a much larger scale. So as we know, insurance is all about contracts and contract law, and those practitioners within that will know that it can be complicated. And as Owen showed you on the previous slide, there are a lot of different contracts involving a lot of different parties to make this kind of stuff work. So captive arrangements, and I'm going to touch a little bit on global programs as well, need to be recognised as complex contracts. So captive arrangements can be primary, excess of loss contracts, or reinsurance contracts, all of which have their own nuances which would need to be considered. And global programs are generally a combination of contracts that cover assets all around the world. Have the next slide, please. So this takes me on to terminology. So on this slide, you can see that I've just listed down some terms that you might come across in relation to captives and global programs. And these are all terms that you're going to need to get to grips with and understand if you want to set up a captive arrangement or a global program. And the reason I touch on global programs is because quite a lot of our clients have global programs that are supported by a captive. So one nugget to take away from this talk today is to make sure that you learn the terminology, but also to make sure that every party has the same understanding of the term. So at AXA XL, we might understand one term to mean one thing, James might mean it to be another, a broker might mean it to be another. So it's really important that when you're talking about a term that you have an understanding about what that term means. So I'm just going to talk you through a couple of those. So one is a direct captive, and as Owen said earlier, that's where the captive has the relevant licenses and in essence acts as the insurer. Most of the contracts we deal with are with a captive front or a captive reinsurer. So that's when an insurer provides the insurance for the captive, as the captive may not have the relevant licenses. And Owen mentioned this earlier, I just want a little touch on licenses and terminology. So you may hear about admitted and non-admitted insurance. So admitted insurance is where in some countries you have to have insurance provided by a licensed insurer within that country. You can't go outside of the country to get some specific types of insurance. And a really great example of that is UK EL. Other countries that require admitted insurance are Japan, China, and quite a lot of African countries. The insurer is backed by the local regulator, and the insurance provisions follow the local regulations. You'll also hear the term non-admitted, and this is where many countries don't require insurance to be provided from within its own country, and they can seek insurance from wherever they like, and that's non-admitted. And a couple of other terms we'll just touch upon are global programs, which we've spoken about, and these are where insurance programs are normally from multinational companies who have a presence throughout the world and require insurance around the world. And they will have a master policy and a local policy. And a master policy is normally issued where the multinational headquarters are. And a master policy is an umbrella policy that covers a load of local policies in different territories. And I'll explain that a little bit more on the next slide. Okay, So how are actually claims handled? So we need to think about the structures that Owen put up earlier. If we have a direct captive claim, the captive will deal with the claim until the policy is exhausted and basically will act as a primary insurer. And then the insurer that sits on top of that in Owen's chart will be, in essence, an excess of loss insurer. It's quite uncommon to have directive captive rights. Normally, what's more common is where we have a captive front or a captive reinsurer. So in these circumstances, the insurer deals and pays the claim and then recovers the money back from their captive. Or, which adds an additional complication to it, the insurer can delegate their claims handling either back to the captive or to a TPA. One thing to remember about any delegation from an insurance company is that there will be due diligence that's required. Now, TPAs are really familiar with the due diligence that is required from insurance companies, and they are set up ready to provide this information, whereas new captive claims teams might not. And you need to be really aware of the fact that if an insurer delegates authority to a captive, that there is significant requirements to make sure that the captive can handle these claims on behalf of the insurer. And just a quick word about global programs. So on this slide, you've got a picture showing a master policy. So this master policy might be in the UK, and we've got some little local policies all around the world. Local policies will be normally good local standard, and they'll have a limit maybe of $1 million or $5 million. The master policy will generally have additional cover that won't be available under a local policy, which will include things like product recall or financial loss. So let me give you an example. We've got a dam collapse in Germany. It floods and destroys the town beneath the dam. The insured are completely responsible. It's probably somebody who's forgotten to flick a switch somewhere. The German local policy will respond to its limit, and then the cover will be afforded under the master. The claim will be paid by the insurer, and then if there's any captive retention, the money will be recovered back from the captive. So another thing to take away from this conversation and this slide is you need to check with your insurer about how your claims are going to be handled, especially if you've got complicated global programs. Generally, what happens is that a handler in the local country, so in our example, Germany, will deal with the claim. But if there's no cover, they will need to go back to the master country to see what cover is available. Generally, and TPAs will do something similar, is the local handler, given their knowledge of the jurisdiction, damages, and the legal procedures, will deal with the claim with the help from the master country. Again, the insurer pays the claim and then will recover the amount from the relevant captive. Next slide, please. So this slide, I just want to give you some reminders and some topics to think about and to take away. So it's really important to know how the programme and how the policies work and interplay with each other. For fronted captives, remember that the insurers have the obligation to make sure that the captive is protected and the money flows through the insurance company. So this is back to Owen's point about whilst the captive has the money at the back end, it's actually the insurance company that has the responsibility to protect the captive and to make sure that the claims are settled correctly and the money is paid correctly. And you'll hear sometimes an insurance company go, it's our money. And to start off with, it is our money. It goes through our P&L, it goes through our regulators, and we need to make sure that we're doing the right thing by the captive and also by our own company standards. With a direct captive right, remember that the insurer is acting as an excess of loss insurer, and there'll probably be some reporting requirements that you just need to be aware of. For global programs, just have a think about what countries are covered. There are going to be some tricky countries maybe in these, and you just need to look out for them and try and address any questions that you might have early on. Understand how the claims handling works, as this will differ per country. So a good example is in the UK, we can front for a deductible. In France, you can't. And think about the law that is applicable. So the law under a local policy and the law under a master policy may be different, and the definitions might be different. So a good example of that is the definition of damage in a US policy is significantly different to that under a UK policy. Another corker to be aware of is cash for cover countries. So this is where if you haven't paid your premium, you're not getting your claims paid. So a good example of that is Moldova. So even if you've been given a time limit to pay your premium by the insurer, so it might be a 60 or a 90-day period to pay your premium, if you haven't paid your premium in time for certain cash for cover countries, the claims can't be paid. And the only way that a claim can be paid is under a financial interest basis, which basically means that the master country pays the money back to the headquartered insured. And then you have to think about how you're going to get this money back to Moldova, which is quite a tricky one. And also just be aware about how you're going to pay, how the claims are going to get paid and under what contracts they're going to get paid. So I've got 6 little nuggets for you to take away. Good practice. So one is to go and get to know your claims team before your first claim. Generally, we're a really nice, approachable bunch. So I'd suggest you kind of get in there early and understand and meet them. Set up your claims protocols early before you have any claims. If you've got complicated contracts or local policies with lots of claims, set up some local procedures. And also understand how the captive recoveries will work. Make sure that you can get the MI that you want in the format that you want and raise any specific requests early. So for example, you might have divisional codes that you need in a loss run that an insurer won't know about until you tell them, and they might need to do some IT fixes to get that. So whatever information you need or any specific requests you've got, get in there early. Any specific internal requirements that you might have. So for an example, if you, as a risk manager, you want approval to agree liability decisions, again, discuss these requirements early. If you require specific loss adjusters or legal representation, again, you're going to need to get it agreed at the start of the contract negotiations. Remember, this all falls back to, whilst the money might be the captive's at the end, it is the insurer's responsibility at the start. And also, if you require anything else, such as regular claims meeting or large loss reports, get all of your requests in early. So that's me, and I'm going to pass over to James.
Yeah, next slide, please. Okay, thank you. Good morning, everybody. I'll do my best to try and catch up on the time so we can have the Q&A session. So just very quickly, my role is as a global relationship leader responsible for our largest corporate clients within Crawford, and my background is in insurance and then as a field adjuster, and I now specialise in working with relationships with corporate clients, so this is very relevant to what I do every day. The bit that makes this job really interesting is that no two programs are the same, but that can also bring many challenges around understanding the different requirements of different clients. So how we work with the market, as I just picking up some key points from direct writing captives, what's the captive and what the captive managers actually need from us? Is it line by line data? Is it reserve movements? They have very different requirements. And then if there's an insurer sitting above an excess layer, when do they need to know about individual claims and who's going to do that communication? So is that flowing through the captive or is that coming direct from us? And some insurers will want to know if a claim is at 50% of the potential captive limit, 66% or even 75%, and it's setting out all those procedures beforehand. And then the overall combined data, is there a requirement for aggregate monitoring or overall wider exposures in different classes of claim? So when we're dealing with a reinsurance captive, again, we have some complex contractual relationships to put in place. So they back-to-back agreements with the different parties, or sometimes we even have tripartite agreements. And that can be particularly important when it's, as well as the claims handling, when we're talking about data processing agreements. You know, we can't have different masters and different requirements coming from different sides. And understanding the requirements of the different types of program is absolutely crucial, and all the different stakeholders that are going to be involved. And just to the points at the bottom there, we will work with UK only clients, somewhere we're just in Europe, and then somewhere it's full global in over 100 countries on some programs. And we have clients that will have one claim a year, or they'll have over 10,000. And obviously they're equally important. And then when that one claim may happen, that's probably going to be something big and have a very high profile. Next slide, please. So one of the key things around providing a TPA service or nominated loss adjusting service is the quality and the consistency across the program. And that can be challenging in different markets where there can be different practices, different legal environments, and different insurance company processes. Most of the programs that we work with will try and mirror the master or get close or have a good local standard wording in the local policy. And it's crucial that you do understand the differences there to make sure that claims aren't declined locally and people get upset, or potentially legal implications when they could be referred back to the master policy and the master policy assisting. Another key part of what we would do, and is often the intention of using a captive, is the corporate brand. So the captive's customers can be the local businesses within a corporate insured. And sometimes the programs aren't even compulsory, so we've got to sell the claim handling process to get those businesses to join the captive program. And then often their customers in a retail or hospitality or sharing economy environment could be the claimants, and they're equally important that we look after them, paying genuine claims quickly with a reasonable settlement amount, but still be very conscious maybe about fraud or defending the client's brand and the investment that can be made to not pay claims when that could have wider brand damage implications. All the time controlling costs, which is obviously in everyone's benefits. And another example would be if there's recoveries or opportunities for subrogation. If we're finding that they're not possible, and understanding the reasons why through subrogation waivers or agreements with suppliers, what data can we provide to help everyone understand, and potentially as part of a risk management program, changing some of those contracts. And an example would be on some of our real estate clients and from some of their tenants, they have subrogation waivers against damage from delivery drivers or whatever. But if you've got all the data available and you can measure those costs and potential value of risk improvement or changing, you can make informed decisions on your risk management program. And we're always reporting to reflect the organizational structure, and wherever possible with the right investment, we can build in the client's location codes or identifiers, their own organization structure, and even product information, so that we can give really meaningful risk management information in the claims data that we're providing. Okay, next slide, please. So again, on the financial side of things, this can be obviously very important when we've got local and master policies and different currencies. We have the capability to be able to report in both. You would obviously want to agree and understand the FX rates which are being used. Escalation of certain claims and certain financial thresholds for the captive or for the corporate parent as well. And then advice or escalations on particularly sensitive claims to legal teams, finance teams, regional management, as well as the insurer key contacts that are required. And some of these programs can be hugely complicated in terms of do we need loss funds in local countries? So that can be for different benefits, or because the program structure is different year by year, so we have to set up different loss funding agreements to pay the claims, or if it is a complex program and we're making lots of payments in different currencies, is there value in holding a loss fund in particular currencies to reduce the FX and banking costs to the captive for those paying those claims? And then in terms of the management information, I mean, there's really some very exciting and innovative management reporting available. I see lots of amazing stuff using AI as well in terms of US workers' comp and some of the programs that are out there. But we also have the ability to take in clients' data as well and mix that in the data warehouse with the claims data, which can give some pretty powerful risk management information. That's by, say, footfall or reservations or product information, so that you can get some really meaningful management information to support the risk management program. And next slide, please. So just to finish up and hopefully catch up some of the time there. So, you know, why I would use a TPA? Well, obviously a lot of, I would say this, wouldn't I? That's our job and this is what we do. But there are different reasons and different benefits depending on the type of program. Property programs very different from a liability program. We see captives used on cyber programs, which require very different requirements, or even professional indemnity these days. But understanding these complex structures, you'll find TPAs very experienced in terms of providing the pure financial information that you need, and then the added value, the full-on risk management information that would fit for your philosophy and your program that you have within risk management within your organization. And one of the key things I always say is that part of our role is protecting the captive, protecting the risk manager, and protecting the insurer and all the parties that are involved. Okay, give you some time for Q&As.
Thank you, James. Thank you, Catherine. Thank you, Owen, for those remarks to begin with. As James said, obviously we've got a bit of time now, 20 minutes. We can get some Q&A, and I've already got a few questions here. So I'm going to ask first question to you, Owen, and Catherine and James, please chime in as well if you have thoughts on this. Owen, a pretty basic question, I imagine. Does having a captive in place, if you're working with a company such as AXA XL as your fronting partner, does having a captive in place speed up claims process at all, in the sense that if AXA has been 100% reinsured by the captive, does that make that decision to pay a claim easier? I imagine you probably have to have some kind of policies and agreements in place to begin with, but how does that change the dynamic when it comes to claims management?
So I would say the short answer is it doesn't speed it up, because to the point earlier, you know, the claim is being handled by the insurer. It's the insurer's regulatory responsibility. The insurer is booking it through their P&L, etc. So the short answer is it doesn't. I guess that, you know, there's always an exception to every rule, of course. So is it possible to imagine a claim where it's very grey? You know, is it payable or not under the wording? And I guess in a circumstance such as that, whereas if you were buying traditional risk insurance and your insurer may say, hold on, you know, I'm going on my side of grey here, I don't think that's payable, and you're going to get into a dispute about it. Whereas if the captive was wishing to pay such a claim, you know, it removes the, I don't know, I guess the financial piece of that decision, but it doesn't fundamentally change that the insurer, the fronting insurer, needs to handle the claim as per the wording. So, you know, ultimately, if it's not payable in the front end wording, regardless of whether it's reinsured by the captive or not, the decision should still be the decision, which is, you know, the wording doesn't allow for that. It's not included, and clearly you can't start paying out claims that are not payable in the wording. I think that's in anyone's interest from a regulatory perspective. So I would say that, yeah, the short answer is no, it doesn't. But as with all things, there's an exception to every rule, and I'm sure there are times where, you know, an insurer would have otherwise or could have otherwise disputed a claim, and at the guidance of the captive might say, okay, if you're paying, I'm happy it's within the wording, but it would, you know, maybe we would have disputed it. So but in general, I would say it doesn't speed up the process. I don't know if you want to add anything to that, Catherine, or contradict me.
No, I don't want to contradict you at all. I think the reply is very fair. It all comes back to the insurer is the first line, and then the captive comes in at the back end of that. So I wouldn't say that it speeds it up at all, but I kind of accept Owen's point is that when we do get to the grey, and there is a fair amount of grey in contract law generally, it probably helps.
Sorry, I will add to that in terms of, I agree with the comments regarding establishing policy coverage and following the same process still. What you can do is actually in terms of literally the speed of something once coverage has been attacked. So we would hold loss funds where we can pay claims quicker under the authorities that we're given, or once we've been given the go-ahead. And if it's built in as part of the upfront process, a lot of captives where we know that it is ultimately captives, that we can sometimes agree a more flexible position around interim payments and getting funds to the local business quicker through those funds or through the local insurer promptly. So you can have some streamlined processes in terms of the physical actual speed of moving a claim and getting money into people's hands quicker once you've gone through those coverage decisions.
And James, I'm going to ask the next question to you, and I think it follows on quite nicely from that last question. It might almost be the flip reverse it in a sense. Is a reinsurer of a captive bound to follow the fortune of the captive, or can they challenge the substance of the claim? I don't know if that's best to ask to you first, James.
Part of our role is identifying those where those could be an issues, and sometimes you can have situations where yes, the captive is looking to take the positive stance and trying to pay, but we would work with them and either excess or reinsurance captives, and a lot of my job is the communication flow, is to get everybody on side so that you're not having those debates or issues once the check's been written, and that everybody's on side and understand the potential issues as quickly as possible.
Great. I had one question myself regarding insurtech and kind of new technology, James, which you touched on very briefly in your presentation. We've had another question on a similar theme, so I'm going to try and combine the two. And I'm sure that Catherine will have a view on these as well. So I'm going to phrase it this way first for you, James. What do you think the major priority for captives should be in this era of digital disruption, and how do you think it can impact claim settlements? And I guess the angle I'd probably ask you on the similar question, Catherine, would be, we hear a lot about insurtech speeding up claims processes in certain areas. From what I gather, most of that's in the kind of more kind of consumer areas of claims. Is any of those insurtech initiatives impacting a large account space, and can we see it already being applied to captive programs? So I guess, James, first to you on the digital disruption, what should be the major area of priority be for captives?
Yes, there are some great ideas out there, and of course, as Crawford, we would say, we're part of that process as well. So the innovation and the technology that we're using and bringing to the claims process. So we can have claims that are paid straight through AI, and if they fit certain criteria, there's no actual touching the claims, and reporting the check is, or bank transfer is made as a straight through, obviously with opportunities for things to come out of that process if it doesn't fit the criteria. So yes, there is a new technology, and again, different parties are bringing different things to the process. It's interesting that some of the insurtech solutions, that we've seen can really work really well, but then it's only if it's in certain currencies and they haven't got the ability yet to make payments in certain ways. So we've got lessons to learn from them and things that we can bring into our process, but then we're also saying, okay, if you're going to apply this on a global program or a complex program, how does that actually physically work, and are they quite there yet? So there are some excellent ideas out there that we're bringing into our processes, and that we're bringing in external technology in where it's appropriate. And then also on there's some insurtechs offering cover as well, which again can be sometimes a really great local country solution, but when you try and roll that out into some of the things that Owen and Catherine were talking about in terms of complex global programs where it's not always your tier 1 markets and things like that, that can bring challenges as well. But this is the stuff that makes the job interesting.
Catherine?
I guess my comments are quite a lot of that technology does relate to consumer business, and it works very well. From a casualty perspective, which is obviously my background, it's in its infancy, and as James said, quite a lot of the claims, especially for global programs and captives, they are generally very complicated claims that don't kind of suit a lot of that tech. Now, you will have some programs where, say it's a property program, for example, whereby there might be claims that can go straight through, and as an insurer, we should adopt those and have a look at those. But generally, I kind of echo James's sentiment in that I think quite a lot of it is in its infancy. And bearing in mind the different systems that need to talk to each other, how the funds actually move, the different types of currency, we're not kind of quite there yet in relation to embracing that kind of tech, but it will come.
Yeah, I think where I see most opportunity in the short term, and we've probably already seen it, is where captors are actually taking part in some of those more consumer lines. Like we know more captors are writing third-party risk, things like telecommunication companies writing handset insurance, or aviation companies writing travel insurance. I imagine there's real opportunity there for these captives to be embracing some of those insurtech initiatives, because that is going to do exactly what they want, which is to make those claims payments much more efficient for the end consumer. But that's a slightly different topic, and we could do a whole different academy on third-party risk, I'm sure, and we probably should do at some point in the future. Owen?
Yeah, Richard, I was just going to circle back to the question before that one, actually, about reinsurers being bound or not bound to pay. So, because the more I was thinking, it's actually a very, very important subject when you think about claims handling within captives. So, obviously, when people place their reinsurance outwards, so if you take a big corporate like AXA XL that buys truckloads of reinsurance and has armies of people buying it and structuring the contracts, and we want it to be back to back, as a captive would want it to be back to back when they buy reinsurance. Now, I can tell you from first-hand experience, and not just in AXA XL but other insurers, it doesn't always work like that when it comes to claim. So and I think the challenge is, no matter how sure you are of your contractual wording, if you're a captive who's then buying subsequent reinsurance, there's always the potential for something that will mean that the insurer either doesn't pay or disputes and delays paying. And because even if this happens to, I would say, to commercial insurers a lot, and I'm sure happens to captives as well, you may have a standard reinsurance agreement that you say, right, okay, when I buy reinsurance at the back of my captive, I'm going to use this standard wording. Great, it's been through my lawyers, everyone's approved it, I think it's as cast iron as it can possibly be. But what tends to happen is, once that gets out into the market and you buy reinsurance, some underwriter somewhere is scratching through a certain clause or adding a different clause, or these things get amended as they get placed. And then you think you've got your panel back to back, and you purchase this panel and great, I'm protected, and then suddenly you've got a chunk missing when it comes to claim. So the piece of advice I would give around that is, obviously everyone, you may need to buy reinsurance, that's fine, but a far better option is to only put into your captive the net which you wish to take. That way you avoid the potential for being left with much more than you had originally intended. It's far better to build risk that you don't want into your tower of insurance, rather than to put it into your captive and then buy it as reinsurance, because you are exposing yourself to risk if you do that you won't get it paid. And again, I think that gets missed sometimes when people structure deals.
Thanks for that, Owen. We did have a follow-up question exactly asking what you just answered, so really appreciate really appreciate the reinsurer view, because of course AXA can play and do play a role at both sides of programs, don't they? They'll front programs and they'll often be a reinsurer in the kind of upper layers as well. Again, I've got another question which I'll ask to James, and I think Owen and Catherine will have a view on this from the fronting side. We hear a lot about captives being used to incubate risks or write risks which maybe aren't available to buy cover for in the commercial market. And so we hear often the role of the captive is to incubate that and collect data to understand the risk better. I guess, James, from the TPA's perspective, when it sounds like a very nice idea. What does it really mean in practice? How much do you see captives doing that, and how much do you work with captives who are doing that? What role do you play in that? And then Owen, on the AXA XL side, what role can, if any, AXA play in fronting the program if maybe they don't write it actually themselves in the commercial market? So James first.
So I have seen that with some of my clients. It's not usually something that's completely new and outside of their realm, but it's an added feature that they're looking to add or enhance for the ultimate product that they're maybe providing to, if they are consumer products. And on some corporate clients, I've also seen it where they're actually getting into a new line of business themselves that they don't quite understand, or it's still new to them, of setting up their new partnerships and structures for new services that they're providing. So what we've had with them is to understand what they're looking to achieve, what additional data we need to capture, and we've had ring-fence projects around capturing those claims. It may not even be claims that have ultimately something's been paid for, and you're not just monitoring the financials, it's capturing information about the circumstances and understanding those better, and then they can play those into the contracts or the relationships that they have in place. And that can evolve, and that's, it's not just set in stone at the start. It needs to evolve as that new service or that new product evolves itself, and everyone understands the type of claims or risks that are coming up. And that ultimately allows them something that they can package up and produce, number one, for the captive own underwriting of it, but also for their discussions with their partner insurers or reinsurers, and to deliver to them something and a growing claims history that they can show how they understand it, and that the risks are manageable, or where the variables still are.
Thanks, James. Yeah, so Owen, on the fronting side, are AXA able to work with captive owners who maybe are wanting to write something which AXA don't write themselves, or would be reluctant to write themselves? How does that work?
So I think, and I guess there's a couple of different angles to that. There's what I would call incubator and emerging risk, and then there's risk that's out of appetite for an insurer, and they are different things, right? So I think captives, the principle of using them as an incubator for emerging risk, I think, is fantastic. I'm not sure it's always used fully in that way, but I do wholeheartedly agree with that as a principle. In terms of fronting that, fronting new emerging risk for a particular client, i.e. a risk that's new to that client, is definitely doable. The challenge is when people think about emerging risk and they think about risks that the insurance market has yet to figure out a solution to. The challenge with fronting that is, okay, do I have a wording? Probably not yet, because the market hasn't worked out yet. Do I have that wording lodged over the world? No, probably not. Do I have the claims handling experience? That could be a challenge. So I guess with emerging risk, it depends how far out there and how beyond the realm of existing risks they are. But true out there risk that the market as a whole is yet to get its head around at all, I think it's quite challenging to find a fronter for. I mean, it can always be done. There's always options, but it's not easy, and that's because there's more to fronting than just putting out a bit of paper. It is handling the claims, it is understanding the risk, and these risks are emerging for insurers as they are for captives. But that's what I'd say for the more extremity pieces. The appetite piece, just on that briefly. most insurers will front and like to front risk that they don't have appetite for to a captive, in so much as, you know, okay, I like your business, but maybe I don't want to play as low. You know, that's out of my appetite. Well, okay, bring the captive in and I'll front for that. Fantastic. Or maybe there's an extension in there that in your wording that I don't have appetite to write as an insurer. Great, put that into the captive. You know, I can front that. Where you would struggle is if an insurer is simply not in a line of business because it doesn't have appetite to write it. It's unlikely therefore to have the capability to front it, because you need underwriters in that space and wordings and claims handlers in that space. And if they're not writing it for their own balance sheet in some way, shape or form, a funder is unlikely to have that resource and capability.
Great. Well, I think we will wrap it up there. I really do thank James Rayner, Owen Williams, and Catherine Barron for your expertise, insight over this hour on captive claims. AIRMIC does have a lot of resource regarding captives and supporting members if they're interested to find out more about captives. If you want to find out more about captives, do drop me an email. I haven't got it on a slide, but it's richard.cutcher@airmic.com. Always happy to support members on this topic, particularly at the moment. I'm getting emails every week from new members interested in captives for the first time, which I'm really pleased to see. So anyway, thank you to Owen, Catherine, and James, and thank you for joining us. And we'll see you again soon. Take care.
Thank you.